Everyone, and welcome to Chapter 9, which is Standard Cost and Variance Analysis. So if you remember from Chapter 8, we went through the process of budgeting for Cliff Bar. So we said, hey, I think I'm going to spend this amount on DM, DL, OH, SG&A, all of that good stuff, aggregated it into our pro forma income statement and balance sheet. And now I'm saying, how close was I? Did I have any variance? Did I have any difference here? Okay, because my standard is what it should have cost me. That's what I established in Chapter 8, how much it should cost me per pound of direct materials, how much it should cost me in direct labor to produce one slab of Cliff Bar. Okay, so now what we're going to do is we're going to go through the process in Chapter 8 of saying, how close did we get? Or in Chapter 9 is saying, how close did we get? So if you'll remember, this is what we would call a standard cost card for Cliff Bar & Co. So the standard cost card is a cost card. I want to say Costco. The standard cost card is a form showing the standard unit cost, how much I expected it, how much, when you see standard, I want you to think how much it should cost, okay? So again, we did this calculation in Chapter 8, where we said I should use 4 pounds per unit at 2 pounds for a total of $8 in DM to produce a slab of Cliff Bar. It should take me 0.2 labor hours per unit at a cost of $20 an hour for a total of $4 per labor. And I don't want to say hour per se because it takes 0.2 hours, but it should take me $4 in direct labor to produce one slab of Cliff Bar. Same thing for variable manufacturing overhead and fixed overhead. So we have a total of $18 per Cliff Bar, or per Cliff slab, I should say, that it did cost me, or what it should cost me, how much my standard is. So now we have to ask ourselves, well, what happens if this happens? What happens if it actually takes me 4.2 pounds per unit? Okay, so now it didn't take me my standard of 4. I thought it should take me 4, but it took 4.2. Well, I'm going to call that a direct materials efficiency or quantity. I'm going to call it a quantity variance. There was a variance in the quantity of direct materials from what I should use versus what I did use. What if it actually takes me 0.5 labor hours per unit instead of 0.2? Okay, I have a variance in my direct labor on how efficient I was. So I have a direct labor efficiency variance, right? Because it's not a rate variance, because my price, it doesn't tell me that my price was any different than what it should have been at $20, but it tells me how much input I had, how many hours I had. I wasn't very efficient. It took me longer than it should have. What if it takes 1.75 machine hours per unit in my variable manufacturing overhead? Well, it should take me 2. It only took me 1.75. So I have a variable overhead efficiency variance. Okay. So we're going to go through and label, hey, these are the variances that I have, right? Because what it should have taken me, my standard, is different than what it actually took me. So I calculate variances after everything is all said and done. So variances can be either favorable or unfavorable. Think about the things that we just talked about, okay? Hey, it took me more direct materials than it should have. That's unfavorable, right? Because I'm going to have to spend more in direct materials because I'm using more per slab of Cliff Bar. Converse that with down here, hey, it only took me 1.75 machine hours per unit when it should have taken me 2. I was efficient. That is a favorable variance. So favorable variances just occur when the costs, my actual costs, are less than my budgeted or standard cost. And unfavorable variances typically or always occur when actual costs are more than budgeted or standard costs. So what I always tell people is, with favorable or unfavorable, don't necessarily think about them as good versus bad. Okay, we don't necessarily think favorable always means good. It costs less than I thought that it should, but then I have to ask myself why. Say it costs me less in direct labor than what I thought that it should based on my standard. Well, what if I just hired a bunch of unskilled laborers that are producing a very low quality product? Sure, my cost is less, I have a favorable variance, but that doesn't necessarily mean that it's good, okay? So you will always denote variances as either F or U based on if it's favorable or unfavorable. We never assign a negative sign, okay? We never negate values. We just say, hey, it's favorable or it's unfavorable, okay? So with this variance, the biggest variance that you can have is going to be your total budget variance. And so we call this a static budget, or a budget that is based on one estimate of volume. So we are going to compare our master budget, what we did in chapter 8. We prepared this. If you go back to chapter 8, you'll see that we had total manufacturing costs of $360, okay? Now we're saying, here's my actual results. So I am comparing, right, what actually happened compared to what I thought should happen, right? My master budget is an estimate of both units and all of the inputs as well. So the control process begins when we have actual results to compare to the master budget. Again, now we're in a situation that we can compare something. And we're saying that actual results showed 25,000 units produced as opposed to 20. Okay, difference in units produced. And I had 400 in manufacturing or product costs versus 360. So I have an unfavorable variance because my cost was greater than what it should be of 40,000. But it's hard for me to know, just looking at this right here, on, well, did I spend more just because I produced more units? Like, yeah, of course I had more in manufacturing costs. I based this budget off of 20 and I actually made 25. But remember, we have all of these different inputs. 4 pounds per unit at 2 pounds or $2 per pound, 0.2 hours times $20 an hour, so on and so forth, that each of these individual pieces could be wrong. And we wouldn't capture that if we just completely attributed our variance to the difference in volume. So we break that out and we have what is called the flexible budget. And a flexible budget is a revised budget that adjusts for actual units produced and sold. Okay, so I am going to have my flexible budget in the middle of my master budget and my actual results. And notice here, just like the definition, my flexible budget is based off of 25,000 units, which is how many units I actually produced. Okay, so remember, our actual results from the last slide told me that I had 400,000 in total product cost. Okay, now when I make my flexible budget, well, all of a sudden I see 425. So what that tells me is that I have a total budget variance down here in this red bracket. I'm going to call that my total budget variance. And again, that's going between my master and my actual. Well, that is going to be an unfavorable variance of 40. However, my flexible budget told me that based on my standard costs and quantity, that I should have spent, right, $425,000 in product costs to produce my actual level of production of 25,000 units. So I have a $65,000 unfavorable variance, but I know that I need to get back to only a $40,000 unfavorable variance. Okay, so when you're doing problems, I would heavily suggest make an actual column, make a flexible budget column, and make a master budget column. And be cognizant of your level of production, okay, under each different budget. Because a lot of questions are going to be, how do you calculate actual to flexible? That's called a spending variance. How do you calculate flexible to master? Well, that's our volume variance. How do you go from actual results to master budget? Well, that's our total budget variance. Okay. So here in this question, we're going to assume that Papa John's standard unit cost and master budget for 20,000 units are as follows. So number one, this is going to be important. Okay. Why? Because I'm seeing that I have a master budget based off of 20,000 units, but I actually produced 25,000 units. So when I'm preparing my flexible budget, how do I calculate how much it should cost me in pizza dough? Well, my flexible budget, the only thing that changes is the amount of units that I use. So I'm going to say I have 25,000 units produced at 80 cents per unit for a total of $20,000. Now I apply the exact same concept down, right? 25,000 at 0.2 or 20 cents gives me 5,000. 25,000 units at my standard cost of 1 is going to give me 25,000. 25,000 units at my standard price of 0.25, how much it should cost me in variable manufacturing overhead. That's going to give me 6,250. And now I'm down to my fixed manufacturing overhead. How much should that be? Well, remember, my fixed manufacturing overhead is fixed. It doesn't change based on my level of production. So I just pull this right over. It's just my 10,000. It doesn't change. So my flexible budget is going to tell me that for my actual level of output, I should have spent $66,250. Okay. So then I need to understand, well, what was my actual budget to be able to determine all of the different components to my variances. Okay. So that's kind of a rough intro to standard costing, variance analysis. Join me next time where we'll start getting into spending variances, quantity variances, DM, DL, OH. So I will see you then. Bye.